Hello and welcome. I'm Laura Superno, Research Editor at BNamericas. Today I'm joined by Rafael Marchi, Managing Director for Infrastructure and Capital Projects at the management consultancy Alvarez and Marsal. In this video, we'll outline some of the main findings of our 2024 Mining Capex report, followed by a discussion about the drivers of spending in the mining sector. BNamericas Capex report covers a sample of 30 mining operators key to the Latin American region. This includes the world's biggest miners that operate in Latin America, as well as the most important regionally based companies. Because most of the operators do not provide information on their spending by jurisdiction, the numbers shown here are the company's global spending, giving us a broad view of expenditure trends in the mining industry. And I invite everyone listening to review our 2024 Mining Capex report in full for details regarding the spending focus of each company. And now into the overall numbers. Our sample of 30 mining operators key to the Latin American region is planning a combined capex of $75.3 billion for this year. This number includes $650 million in guidance planned by Arcadium Lithium, a company which was formed recently by a merger and so is not included in the data for previous years. If we remove Arcadium, the remaining 29 companies' guidance for 2024 is $74.7 billion, which is 13% more than their real spending in 2023, which reached $66.1 billion. This 13% would be the largest percentage increase for this group in the last 3 years, and in general consolidates a trend of capex growth over the past 7 years, where the only exception was 2020. The company's 2024 guidance shows unprecedented levels of spending for the majority of operators. 21 of the 29 operators in our sample, or 72% of the operators, have reported their highest guidance figure since we began keeping track in 2017. 8 of the miners sampled are planning to spend $3 billion or more in 2024. The average guidance among these 8 operators is $6.14 billion. And the average increase among these top 8 miners is 16% over their 2023 spending. BHP and Rio Tinto stand out, of course, each aiming for $10 billion in spending in this year alone, which for each company would be a 41% increase over last year. These 8 companies planning $3 billion or more of spending account for 65% of the guidance sample that we're covering here. The group is comprised of the 5 major global diversified producers, as well as Codelco, Freeport, and Newmont. And this marks the first time that one of the precious metals-focused players covered in our sample joins this list of those planning to spend at least $3 billion. 13 mining companies in our sample are planning capex of between $1 and $3 billion in 2024. These are led by strong growth in planned spending at KGHM, Southern Copper, and Antofagasta. Another 9 operators are planning spending of less than $1 billion each. This chart shows the percentage change in capex planned by each company. So 18 companies in the sample are planning to raise spending by at least 10% in 2024. 18 companies, that compares to 15 companies a year ago that were planning at least 10% increase. And 8 of the companies are forecasting variations within 10% plus or minus, and another 3 are looking at reductions greater than 10%. And the largest of these is Teck Resources, which of course is winding down spending on its major Quebrada Blanca 2 project in Chile, which will explain this reduction in capex. Here we see a comparison of 19 operators in our sample that are focused on industrial and base metals, such as copper, iron ore, zinc, and lithium, compared with 10 companies that are focused on precious metals, so gold and silver primarily. 2024 marks a second consecutive year in which the industrial metal miners are planning to increase spending at a faster rate than the companies focused on precious metals. So the 19 industrial metal producers combined guidance is for $62 billion this year, and that's a 14% increase over what they spent last year. The figure represents a 95% increase over these companies' reported spending in 2017, the year we began our Capex reporting. So in just 6-7 years' time, we're talking about almost 100% increase in spending. The precious metals focused miners in the sample are aiming for a collective 9% Capex increase in 2024, which is in line with the increase they achieved last year in spending, and would lift this group of 10 operators to spending of 12.6 billion in 2024. Breaking the numbers down a little further, not only do the industrial mineral miners plan to increase spending at a faster rate than the precious metal miners, but in particular, they will increase their expansionary spending at a higher rate than their sustaining spending. This represents the continuation of a trend that emerged last year of strong growth in expansionary spending plans among mining companies focused on industrial minerals. Overall, their sustaining spending is still greater than their expansionary spending, but the rate of increase is higher for the expansionary capital. The producers of industrial metals, many of which are now considered critical minerals, of course, these companies are targeting an overall increase in expansionary spending of 22% this year, which we think is indicative of the generalized focus on growing output to support the global energy transition and also to capture the higher metal prices that this transition is expected to generate. So with that, we conclude our presentation, and I'll invite Rafael to now open the camera for our discussion. Hello, Rafael, and thank you so much for joining us.
Hi, Laura. Thank you for the invitation. It's a pleasure to be here.
So thinking about some of the numbers we just looked at and your experience in the mining sector, just in general terms, what do you see as the main driver or drivers behind this kind of steady increase in mining industry spending we see in recent years, and which is again planned to take place in 2024?
Yeah, I think there are two main factors that combine these trends. So one for sure is the energy transition, right, which is increasing a lot the critical minerals such as copper and others that are lithium and others that are increasing in a much higher pace than other types of minerals. And also this spending it also relates for a depletion of some mines, and then the companies, in order to try to keep the same production levels at the same moment that the cost of production is increasing because the mines are getting deeper and more costly to produce. They have to spend in order to keep the production. So I think that there are the two main reasons for that we can see for these trends, and looking for the future. I think these are very solid and continuous trends.
Mm-hmm. What do you see as the effect of inflation that has emerged basically following the pandemic? It certainly over the last couple of years has been really important. How has this affected the cost and the requirement of companies to actually spend more to achieve the goals that you mentioned that they need to achieve, and how do you think this might continue to affect projects? Are we kind of coming out the other side of that, or is it still a major concern?
All those capex investments, so all those projects, they are basically, if we can put down them then on some materials, they're roughly like steel, right? So because they are steel structures, so the demand for steel for these projects is huge, and the inflation of steel cost or the higher cost of steel production around the globe also transfers these costs to the projects, right? For making the mining companies, they have to invest more to buy those materials. Also concrete and fuel. So I think especially concrete, I think there was a big increase recently after the pandemic, and I think that these will we've seen some of the costs going a little bit down on this product. But when we come to steel, for example, because of the decarbonization and because also the higher pressure on the steel making processes and the companies, there's a trend of keeping high prices for these materials, which also reflects on a higher cost for the mining companies to do their investment. So I think that's something that's going to keep growing. And also something that we've been seeing in Latin America overall is the cost of manpower. So these will also transfer the higher cost of manpower will be a higher cost of investment of a project. So I think that these are the factors.
Perfect. Interesting, as you mentioned, because with steel and iron ore itself becomes a critical mineral. Companies are trying to produce more critical minerals, yet they're also exposed to the increasing prices of the minerals themselves. So interesting.
Exactly.
And in recent years, we've seen, at least in some countries, really increase in strong, social movements. There have been political shifts, things that have made decision making perhaps a little more difficult for mining companies. I'm wondering, what you've seen in terms of how these impacted the industry in terms of costs. For example, if our permitting process is, longer to the extent that project costs have risen, how is that influencing the amount of capital that companies actually have to lay out in order to grow or to even do their sustaining projects?
Yeah, so if we take Latin America projects, there's a big, they're very close to many communities, indigenous and local communities. And the local governments, they are very linked to those communities. So the amount of demands that local communities are making for the mining companies has increased. And this, for certain, in a way, makes the cost of the projects more expensive. And besides that, I think there's also a delay in the permitting process and also the developing timeline of the projects, which also causes a higher cost, right? Because there's an indirect cost related to the schedule of those projects. And if they put these projects, they take longer, for sure the capex of them is going to be higher, right? So and also, the climate changes and all the ESG pressures that are not only on mining, it's all the sectors. These are definitely trends and factors that are causing a higher cost. So especially if we take just for an example, right? The water usage. So even though the mining companies, they recirculate and they use a lot of they recirculate the water. So the need and the consumption of the water is much lower today than compared to the past. Now there's a bigger trend for mining projects, especially in Chile, Peru, and in the mountains, to not use a local water or water from the continent. So there's a pressure for getting desalinated water from the ocean. So these also create a higher pressure for the mining companies, and also the usage of energy. So nowadays there's all the mining companies also, they want to be cleaner and ESG. So they are forcing and pushing to have every day more usage of clean power. So and this again turns the cycle back, because clean power like wind and solar, they require more copper, they require more steel, more iron ore to produce. So again, this causes some type of pressure on the demand, which also relates on the price of those commodities.
Mm-hmm. Perfect. And this little what we've talked about so far is companies, or sorry, the costs increasing and the struggle to maintain production. What we're also seeing now is companies actually growing their expansionary spending. How do you see, because a lot of that spending is just, spending has gone up even just to maintain production levels, right? Projects that are, life extensions and things like that becoming more costly. So we've seen in the numbers, as I showed, greater expansionary spending, particularly among the miners of critical minerals, right? Copper in particular. We cover a lot of, Vale, iron ore, and the lithium producers. Do you see that as a trend that's probably going to continue to grow? I mean, could we see continuing increases in expansionary spending as well? And how are the companies actually going to be able to get there, considering the challenges in moving projects forward? Will they be able to expand at the rate that's needed, I guess?
Yeah, that's a good question, because the pace of what is needed is something that really is not a consensus, right? So, but what is a consensus is that our production has to be higher, and that's the difficult part of it, is to know the exactly pace, the exactly amount. But if we take, like, from your charts, the first two, Rio and BHP, the amount of investment that they are putting this year is much higher compared to the other years, the previous years. And for sure, that is not only the cost of sustaining, but also trying to get a slice of a bigger market share, to have a bigger production, to keep and maintain, or even increase their market share in the market. So, and I think those numbers were basically because of permitting and political problems or issues that were happening in Chile, that were delaying some projects to be approved. And now I think there's a wave of project approval, so that's why the capex of those companies are much higher this year in comparison to the previous year. But if we go for others like Vale that you mentioned, there's a huge pressure on Vale in Brazil for getting away of the dams, to use more dry stacking, and to implement more efficient or less risky tailings management systems. But for sure, this is causing some additional sustaining capex, and just to maintain the operations. But for sure, Vale is also looking for expansions and new regions and new projects that are necessary for Vale to keep the production. If you take their production for copper, just for example, they are investing just because some of the mines are getting at the end of the life of the mine, so they're investing for keeping the pace. But they're also looking for new projects to increase the production. So I think in general, all the majors, they are doing both movements, right? They have to invest more in the sustaining, and at the same time they have to invest more in the expansion, because the projects are more expensive. They are not so good in comparison of quality with the past. So just if we take another big player, Codelco, they're suffering to keep the same production levels that they used to have, because now the mines are deeper. The productivity rates of the concentrate are lower than it used to be. So this is a global trend. It does not only affect one company, it affects all of them. And I think the hard part here is the combination of those. So the selection of the good projects and the good assets I think that's something that all the companies are constantly reviewing their portfolio in order to achieve and maintain the more effective, the best scenario for combining these two very complex worlds, which are the sustaining and the expansion.
Yeah, very interesting. I'd like to ask you one more question, if you don't mind. I'm curious, what you think might be the role of kind of industry, consolidation in the rising capex numbers, because I mean, looking at least at our report and the numbers that I presented or we've been compiling over the last several years, we covered the top 20 or 30 miners, but the top 20 or 30 miners are larger than they were 7 years ago. They've, bought other companies. Newmont is this for the first time we see a precious metal miner spending, guiding for over $3 billion in capex for a single year. Well, clearly Newmont has grown significantly in the last few years with M&A. BHP has acquired companies, Glencore has acquired companies. Does that bulk up or increase the spending of each of these companies, or does it actually sort of even out or flatten out a little bit the overall spending of the industry? Because sometimes when these companies buy projects, then they divest, and some of those projects, only the best assets actually go forward. As you were just mentioning, they have to really look at their portfolios and only go ahead with the best pieces. So what do you think in terms of, what's the effect of consolidation on this? And
I think the effect of consolidation, and recently, right, I think last week there was the news about BHP and Anglo, which it's exactly that, right? So I think they gain, there's an objective of really fighting against those inflation trends. So you have a bigger company with a bigger bargain power for many types of acquisitions, of procurement. They get efficiency on many aspects, and also the synergy between some assets. So what are these companies are doing is really try to have more efficiency on the operations, and sometimes the best way to do that is really join forces with their neighbor and have a bigger operations and work together. So in this we are seeing this case of BHP and Anglo. We've been seeing partnerships from Vale and Anglo in Brazil for developing projects together in order to take advantage of logistics and take advantage of local aspects of the project. So there are many factors related on those M&As or those consolidations, as you said. And another thing is control, and not controlling, but it's to have also a better knowledge about prices, right? So all of those conglomerates that are becoming together, they create a huge pressure in terms of controlling the prices of the commodities. So and this also has the fact with geopolitics, which go much over the company. So and we see that a lot in the lithium space and in the rare earths and all those critical materials that there's a lot going on in terms of geopolitics, in terms of supply and demand globally. So this is something that from your first question, I think the companies in the countries learned about after the pandemic, right, or during the pandemic. All the supply chains that are very rely a lot on China supply. They're trying to diversify as much as they can in order to keep the supply a more stable supply. So there are many factors on that, right? And as you said, all those combinations, they create companies that are focused on efficiency. They are looking on the best assets, right? And by reviewing the portfolio, sometimes there's also opportunities for other companies for the, I would say, not so good assets that maybe are good for smaller companies, because those big companies, they have big overheads, sometimes they're low, and we've seen these also, right? Many assets that were not efficient in the hands of major players that become efficient in terms of cost production, the production cost, right? On the hands of smaller companies. So I think that's something that's really healthy for the market in general, also, because you know, the big players know how to handle big mines, but we definitely need juniors and medium tiers operating well, because they are also responsible for pushing the prices down as a reference for the market. So that's it.
Perfect. Thanks so much, Rafael. I don't know, any final thoughts regarding, you know, spending outlook for this year, or what you think is to come, or?
Yeah, I think what is to come this year is very important. You know, there are some elections coming, especially, you know, in the US and countries that are very important, that they push the ores that are produced down here in Latin America, that we have to keep an eye. Also the trends in terms of oil prices that affect a lot the mining costs. So this is something that we have to take a look, and always keep an eye on the new technologies and new batteries and new stuff that are coming, that are really pushing and driving the prices and changing the prices, and also new players to see different metals, different ores are embedded on different countries. Like if we saw what happened with nickel because of the entrance of Indonesia, of China in the market. So these are trends that we have to be aware. And every different commodity has to know its field of competitors and players and countries and geopolitics, because these might affect differently on the companies based on where they're playing for, where their consumption and the projects that are available also, right? Because these are a trend that we have seen, the lack of projects or world-class projects, they are getting much harder to find, and all the companies are looking. And also maybe another trend that we are seeing a lot here is the presence of, in terms of investment, of the Saudis and the Middle East countries that are coming down much more to Latin America to try to solve their also supply issues. So I think that's a trend that we have to be aware and to keep an eye on those movements also.
Perfect. Thank you, Rafael, so much for being here today, for sharing your insights regarding spending outlook for mining this year, and, you know, what are the key trends we need to be watching out for. It's been a pleasure talking with you. And that concludes our Mining Capex overview for 2024. And I will invite everyone listening to check out the full Mining Capex 2024 report on the BNamericas.com, and to have a wonderful day. Thank you.
Thank you, Laura.